Welcome to the IRA 2021 updates by Dr. Melissa Cohen with smartandsassymoney.com. IRA stands for Individual Retirement Account, and just recently the IRS released some changes for 2021 that everyone needs to know. Specifically today, we are going to talk about the employee contribution amounts for 2020 and also 2021. We're going to take a look at the income level changes for married couples, as well as the income level changes for single filers. The good news is the employee contribution amounts remain unchanged, and therefore there will be no changes from 2020 to 2021. However, there will be income limits are going to increase based on the cost of living increases. Okay, so just as a review, if you weren't quite sure what the 2020 contribution limits were, we're going to talk about this. So it's actually going to be the same for 2020 and 2021. If you have a 401k plan at your work and your contribution can be up to $19,500. But if you're aged 50 and over, you can contribute an additional $6,500. The Roth IRA contribution is $6,000. And if you are an individual aged 50 and over, your contribution amount is $7,000 for each year. Now, there are a few conditions for a traditional IRA. Taxpayers can deduct contributions to a traditional IRA if they meet certain conditions. So if during the year either the taxpayer or his or her spouse was covered by a retirement plan at work, their deduction amount may be reduced. It may be phased out until it is unlimited, and that's going to depend on filing status and income. So if neither the taxpayer nor his or her spouse is covered by a retirement plan at work, the phase-outs do not apply. So let's take a look at what these income phase-outs for single taxpayers are. So if you are covered by a workplace retirement plan, the phase-out range is $66,000 to $76,000 for 2021. So if you make less than $66,000, you can get full advantage of the contribution. If you make $76,000 more than that, you get zero benefits, tax benefits and such for these contributions. And just for reference sake, for 2020, that phase-out range is $65,000 to $75,000. Now, the income phase-out for married couples filing jointly, taxpayers. So if you are covered by a workplace retirement plan, the phase-out range is $105,000 to $125,000 for 2021, and that is up just $1,000 each from 2020. So that 2020 amount is $104,000 to $124,000. So what do you do if the income phase out for one person is not covered by a workplace retirement plan, but is married to someone who is covered? For an IRA contributor who is not covered by a workout retirement plan, but you're married to someone who is covered, the deduction is phased out if the couple's income is between $198,000 and $208,000, and that's for 2021. And this is up from $196,000 to $206,000 for 2020. So basically that means if two people are married and one person has a corporate job where they have an IRA contribution through their workplace and one person does not, whether maybe they're a stay-at-home worker or stay-at-home parent, or they're a part-time worker and they don't contribute to a workplace plan, the income amount actually increases from that to $198,000. So if your household makes less than that, you still get the full benefits. There's the phase-in range up to $208,000. And anything over $208,000, you do not get any benefits for the contributing to your IRA account. Now, if you have any further questions or need to know any additional information, you can check out these two references to specific IRS.gov documents in their full form and entirety, especially if you have a little bit more complicated information pertaining to your specific circumstances. Once again, thank you for joining me regarding the IRA 2021 updates by Dr. Melissa Cohen. And if you have any further questions, please feel free to reach us at smartandsassymoney.com.